Despite all the research you need to do, buying a stock is relatively easy. But when it comes to selling, it's always a struggle. On one hand, you're afraid that if you sell too soon, the stock will continue to rise and you'll have left a lot on the table. But on the other hand, you're anxious that if you wait any longer, the market could crash and you'd miss your chance to sell. While it's not a good idea to sell a stock just because the price has risen or fallen, there are times when it's absolutely okay to place one or more sell orders. In this video, I'll explain the exact situations that could warrant selling a stock. Welcome to Cent Essential, and let's get started. The first scenario when you should consider selling would be at your planned exit point. Earlier on, I mentioned that extensive research is required before buying a stock. I have found that every time I've bought a stock just because someone else said it was a good one, or just because the stock is rallying, I have always had a hard time knowing when to sell it. I have ended up either selling it too early because I have little confidence in the stock, or selling it too late simply because I didn't want to accept that I had made a mistake. In each of those cases, I've made those decisions because I didn't have a clear and foolproof plan for the stocks. As an investor, you'll always have a difficult time selling a stock if you never did your due diligence when you bought it. That's why it's absolutely crucial to make sure that before you place a buy order, you have created a comprehensive plan, also known as an investment thesis, for that particular stock. Creating an investment plan is something I intend to cover in another video, but here are the simple steps you need to take. First, check out the stock's valuation and determine its fair value. Next, identify your entry and exit points for the stock, meaning the price that's fair enough for you to buy and the price at which you'd like to sell the stock at a profit. And while you're at it, identify situations that would make you exit the position before your selling price is reached. Now, when you've come up with such a plan, make sure to follow it to the letter. Having a plan in place will counteract all the emotions that come with the decision to sell a stock. Just make sure you stick to the plan. The second scenario when you should consider selling is if you've made a mistake. A mistake here does not constitute you buying a stock and then the price of the stock goes down. Price alone does not indicate a mistake, since stock prices fluctuate all the time. What constitutes a mistake is you buying a stock that you barely know anything about, or even succumbing to FOMO after watching a stock make phenomenal gains over just a few days. FOMO here means fear of missing out. An example of a mistake I made recently was buying Smile Direct Club, ticker symbol SDC. I bought SDC last year after a massive dip but didn't have an idea about the business itself. The stock hit 52-week low after 52-week low and lost more than 65% of its value. It got so cheap that I thought I was getting a bargain. After all, it can't go lower than that, can it? Well, I was wrong. I didn't look at the company's fundamentals or any of its financials. Another unfortunate mistake would be using the wrong numbers to determine a stock's valuation. Even the most experienced investors encounter this situation at some point in their investing life. So, in these circumstances, selling the stock is the wisest course of action, even if it means incurring some losses. And to avoid making the same mistake again, resist the urge to chase after hot stocks that are running on vapor, since they may end up ruining you financially. The third scenario when you should consider selling is when fundamentals of the business change. You'd be quite mistaken to think that after doing your due diligence, creating a plan, and eventually buying a stock, your work is done. Not quite yet. You still have one more thing to do. You have to keep up with the company's quarterly performance to review whether the business is on track with your investment thesis. A company's quarterly earnings report or guidance could reveal that the reasons you bought the stock in the first place are no longer valid, and it could be for any of these reasons. 1. The company is losing market share, maybe due to increased competition. 2. There's a fundamental shift in the company's business model that changes your projections. 3. Slowing down of revenue or earnings growth. 4. Key members of management have left the company. 5. Increasing business costs and lower margins. 6. New regulations that affect the bottom line. Now, it's important to note this. Any negative news from a company, for example poor earnings or low future guidance, usually triggers a quick and severe response from investors. So it shouldn't come as a surprise if the stock drops more than 10% in a matter of a few hours. Always listen to earnings calls and never miss an earnings report or a company's guidance report. Because if something ever slightly changes towards the negative, you'll need to quickly determine whether the situation the company is facing is temporary or permanent, and thus promptly decide whether to sell or hold. The fourth reason for selling would be when you've identified a better opportunity. As an investor, you want your portfolio to contain the best stocks you can find. Suppose you encounter a fantastic buying opportunity for one of your favorite stocks and you'd like to buy it as soon as possible. Ideally, you'd use your saved cash to make the purchase, but what if you don't have the cash? The next best option is to look at your portfolio and identify a stock that doesn't have as much potential as the one you'd like to buy. By selling such a stock, you'd be able to free up cash needed. Even though there's probably nothing wrong with the stock you're selling, seeing a good long-term opportunity elsewhere can be a compelling reason to sell. The fifth scenario when you would consider selling is when you need the money for personal reasons. While it's never a good idea to invest money that you'll need in the next few years, there might come a time when you really need the money. Our lifestyle changes all the time. For example, if you're a young investor, you might need to sell part of your portfolio to raise cash for a house down payment or a car down payment. And if you're an older investor, you might want to reduce your exposure to risky investments like stocks and move your money to bonds. Another common situation when investors sell out is when they have children who plan to attend college and so they'd like to raise cash for tuition fees. Now let's look at 3 situations when you should not sell a stock. 1. When the stock price has increased. Don't sell a stock simply because the price has risen. Winning stocks rise in value for a reason, and they also tend to continue to do so. 2. When the price has decreased. Don't immediately sell a stock because its price has fallen. Every investor wishes to purchase at a low price and sell at a high price, but selling a stock simply because the price has dropped makes you a trader and not an investor. 3. To reduce your tax liability. Tax loss harvesting is a strategy that some investors use to help minimize their taxable capital gains. They do this by taking losses on underperforming stock positions. And even though it can be a useful approach for some investors, selling equities, even those at a loss, solely to lower your taxes is often a bad idea. It can mess up with your long-term investing mindset. So bottom line, there are times when it's 100% understandable to sell a stock, but please plan it out and don't just sell out of fear of the stock tanking because you'll be doing this every 3 months. Also, don't sell because you want to buy back in when the stock price falls. Trying to time the market is nearly impossible. So let me know if you've been selling and why you've been selling. And if you liked this video, give it a thumbs up and consider subscribing. Thanks so much for watching and see you again soon.